Hello and welcome to the Baird Trust Large Cap Equity Fourth Quarter Portfolio Recap. My name is John Watkins and I'm a co-portfolio manager on the strategy. So I will touch quickly on our recent performance and then make some comments about our long-term track record. In the quarter, our portfolio increased 10.1% gross of fees and 9.8% net of all fees compared to the S&P 500's 7.6% increase. And for the full year 2022, our portfolio outperformed the S&P 500, declining 16.1% gross and 17.2% net compared to the 18.1% decline for the S&P 500. Our outperformance in 2022 was actually in spite of a substantial 3.3 percentage point performance headwind due to the fact that we don't own any energy or consumer staples companies in the portfolio. These sectors were two of the best performers for the year. We have been unable to find investment opportunities in these sectors that meet our business management price criteria. This year, 2022, marks the sixth time over the nearly 30-year history of this portfolio that the S&P 500 calendar year return was negative. Our portfolio outperformed in all 6 down years. We believe this stems from the nature of the businesses that we own. Companies with consistent and positive cash flows, durable business models, conservative levels of debt, excellent leaders, and the fact that we are disciplined on the price that we pay. Our singular portfolio objective is to outperform the S&P 500 over full market cycles. We invest with a long-term business owner mentality, so we are always focused on multi-year periods rather than any individual year. A few items of note. First is the performance over the last 3 years. We refer to this as the pandemic era, and it has been a wild ride. 2020 saw the onset of the pandemic, a 34% crash in the S&P 500 in a month, and emergency government intervention. This fueled a stock market rebound that culminated in rampant speculative activity in 2021 and ultimately led to another bear market in 2022. A lot happened in this compact time period. Over these 3 years, our LCE portfolio compounded at 9.9% annually gross of fees and 8.5% net of fees, which compares favorably to the S&P 500's 7.7% annual return over the period. And then zooming out even further, the 15-year number is worth highlighting because it begins January 1st, 2008. This time period contains the great financial crisis in 2008 and 2009 with the S&P 500 falling over 50%, the subsequent rebound and decade-long bull market, and then culminates with the pandemic era. Over this time period, our LCE portfolio compounded at 10.9% annually, gross of fees, and 9.4% net compared to the S&P 500's 8.8% annual return. The next slide shows the individual companies that were our top and bottom contributors for both the quarter and the full year period. You'll notice that, especially for the full year period, there's a wide dispersion of individual stock price performance. Some were up double digits, some were down substantially. As we often say, a company's stock price is much more volatile than its underlying intrinsic value. That fact was put on display this year and really for much of the past 3 years. Our view is that short-term stock price movements do not tell us much about what is actually happening with the underlying business. For that, we look at things like revenue growth, margin expansion or contraction, earnings, and free cash flow changes. Moving on, this slide shows our recent portfolio changes. In October, we made one change, trimming Progressive and O'Reilly and initiating a new position in Parker Hannifin. Progressive's stock price surged in 2022 and reached our maximum position size of 8% of the portfolio, so we reduced the position. O'Reilly has seen tremendous business tailwinds coming out of the COVID-19 pandemic, fueling the strongest growth it has seen in many years. We opted to trim the position based on valuation, especially due to the compelling opportunity we had with Parker Hannifin. And we still believe both Progressive and O'Reilly are companies with bright futures, so they will remain meaningful holdings in the portfolio. Parker Hannifin is a diversified manufacturer of motion, flow, and process control components for both the industrial and the aerospace markets. Think sealants, adhesives, coatings, filters, couplings, valves, among many other things. Importantly, Parker is an innovation leader, and most of their products are mission critical to their customer, which results in very sticky long-term customer relationships. Parker has positioned itself around several long-term secular tailwinds that should fuel attractive growth for years to come. Additionally, we believe Parker's culture is unique in that it draws on its roots as a family business and is intensely focused on its customers. We have followed Parker Hannifin for many years, keeping tabs on developments in their business. Their recent acquisitions, combined with some share price weakness in 2022, gave us the opportunity to purchase shares at what we believe to be a very attractive price. 2 quick points on portfolio composition. First, we are bottom-up investors, meaning our sector weightings simply reflect where we are finding investment ideas that meet our criteria, not any sort of top-down macroeconomic views. And then second, we believe that outperforming the S&P 500 can only be achieved by looking different than the S&P 500. So you can see from our sector weightings on the left and our top holdings that we do, in fact, look quite a bit different than the S&P 500. Finally, just a few big picture comments. 2022 was a painful year for investors. Stocks entered a bear market and finished the year down meaningfully. Bonds had one of the worst years on record. There was nowhere to hide. Unfortunately, as we know from studying market history, bad years like 2022 are inevitable. There aren't many positives to take from the past year. However, one silver lining is that the wildly speculative behavior that we saw for much of 2021 has been mostly eliminated. Excessive speculation can be very dangerous for investors, and this cleansing in 2022 should lead to healthier markets with fewer excesses in 2023 and beyond. Last year was also characterized by a substantial shift in Federal Reserve policy, with a sharp increase in rates to try to slow inflation. The rapid shift from loose monetary policy to tight monetary policy does have implications for 2023 and beyond. On the negative side, it will lead to economic headwinds. We don't know whether a recession will occur in the next year or two, but it is clear that economic growth is slowing. On the positive side, the tighter monetary policy looks to be having its intended effect on inflation, which is trending in the right direction. So while we cannot predict the future, we do know that it will contain some surprises that we aren't contemplating today. The last 3 years should serve as a reminder that the future is nearly impossible to predict. For this reason, we remain intensely focused on the disciplined execution of our time-tested investment process. We believe that advantaged businesses with talented leaders can survive and thrive in almost any environment, especially if purchased at compelling prices. So that does it for the Q4 portfolio recap. We look forward to reporting our Q1 results to you in April. Thanks so much for your time.